What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is April 11th of 2022. Well, folks, I hope you all are having a fantastic day wherever you are, and in today's video, I want to spend some time to break down an article that has taken the crypto space by storm over the last couple of hours, and that is the Q-Trap article on Medium written by Arthur Hayes, one of the famed names in the crypto space for his affiliation with the founding or creation of BitMEX, which was originally one of the largest derivatives platforms in the crypto space. Arthur Hayes has been in the space for a long time, and within this article, he takes a little bit of a short-term bearish take on the market, talking about how we could be coming down to revisit this $30,000 price range for Bitcoin, as well as $2,500 for Ethereum. I want to go ahead and dive into it, try to break down the main concepts of it, and kind of give my take on it as well. It's not exactly positive or negative in this case. I think he brings up a lot of great points, all the while my conclusion might be a little bit different than his, okay? So first off here, let's just go ahead and try to understand the concept of what Arthur is trying to propose here. As you go through the article, it's a pretty lengthy read. It's estimated to be about a 16-minute read here, so we won't have the time to dive through the entire article and go through everything here, but there's a few key pointers that I want to talk about that Arthur really hints towards. So as we go here towards understanding the thesis here, and we'll come back to the closing part because that's kind of where the substance is in regards to price, or at least his estimations. He's been calling for $30,000 Bitcoin and $2,500 ETH sometime by June. He believes that there's going to be some kind of correction going in here sometime maybe into the spring or into the summer, where we're going to see this pullback back down to that consolidated low range we've seen back in early 2021 and in May of 2021, as well as here in January, March. He really feels that this kind of consolidative channel is probably going to go on for a little bit longer, and then we'd have the spring up event in the crypto market for the next major move higher. Now, as you all know, this is kind of a little bit different than the thesis we proposed, but I think Arthur honestly brings up, all the while I'm not a big fan of BitMEX and derivatives, I have to say Arthur has been in the space for a while, and he brings up a lot of really interesting things on a macro perspective. First off, he talks a lot about the correlation between Bitcoin and Ethereum, the two largest crypto assets making up the vast majority of market cap dominance in the space, having a strong correlation with the NASDAQ 100, as well as other major stock indices. And you can see throughout the charts here, go ahead and zoom in here, the increased correlation here over time, really on a macro scale here with Bitcoin and other major indices. For example, the Ether NASDAQ 10-day correlation, how that's just been continuing to chart higher since back in May of 2021. And this is, again, a growing trend here that people have been talking about. Now, all the while, how you measure correlation in this case between the two, it can vary depending on how people like to model it. But generally speaking, I don't think most of us would argue against the idea that, like, when the market, for example, and equities are going down 2 or 3%, crypto is probably down 3 or 5%, and vice versa. When the stock market is up 2 to 3%, crypto markets, Ether, Bitcoin are probably up 3-5% or more, right? It tends to be that there is some kind of correlation between these two asset classes. So this is one of the points that Arthur brings up here. It's kind of a worrying sign because many people are concerned that the Federal Reserve is going to start quantitative tightening. They're going to start to reduce their balance sheet. This has been a big talking point here over the past couple of months, a big fear factor that people are starting to consider or potentially price into the market. And if equities are going to be hampered by this quantitative tightening, this reduction of money in the system, as there's going to be less money and therefore credit in the system that could stimulate financial assets, that is going to be dragging down Bitcoin and Ethereum with it as well. That's the theory that Arthur is proposing here. And it's a pretty rational one in this case if equities really do start to get hit. The next thing here as well that he points out, just kind of to talk about what's going on in regards to the equity markets, is we've got the ARK ETF here. Now, this is one of the major ETFs by ARK Investments. They've been really they were kind of the poster child of the COVID rally back in 2020 in the equity markets, as there was all these technology companies that were benefiting from an excessively digitized world. And I think, again, back at that time, and I mean, still to this day, there's definitely impacts for sure. Many people thought that we were going to, as Arthur kind of hits, and I absolutely agree with the overestimation here that people had, this kind of tech utopia, that technology was going to 10x overnight. And that we were just going to embrace all these new companies that were just going to somehow become even more part of our lives. And I completely agree with Arthur that that's just not the case, right? a lot of these companies, all the while they've cooled down, they've gotten to more reasonable valuations. We can see here that the equity market has less and less of an appetite for these companies. And you can see here that the ARK ETF has come down versus the you can see here versus the U.S. Treasury 2-year yield. So what I generally want to kind of simulate here, I think what Arthur is trying to propose is that the market is moving towards a more risk-off narrative. They're really not buying into overvalued, overhyped equities, and that's why ARK has been underperforming, which used to be, again, one of the poster child kind of funds to follow, one of the best passive investment ETFs you could possibly bet on. Now is becoming one of the worst performing in this case, as it's full of a lot of these kind of high growth technology startups that are really kind of big bets on the future, where hopefully some of them will pay off, right? Again, it's kind of like early stage venture investing, right? You really got to have a long-term time frame horizon. And what Arthur is really bringing up here is that right now, most of the volume and demand is going towards a few technology companies, and those few companies really have to hold out the markets here over the coming months. So those are some of the major things here. Again, and along with that as well, he talks about one third thing that I think is so important to understand here is not just to follow what the Federal Reserve does. This is a big misconception that people have. And I've talked to a lot of people here on the channel about this. I've talked to, for example, Chris Catcher, one of the traders that we've chatted with a long time, is a good long-term time friend, the crypto space. Now Arthur Hayes and many other macro people, I would even say Raoul Paul and a couple others, who talk about this concept of not just following what the Federal Reserve is doing, but following the monetary policy of global markets and global central banks. And one of the topics that Arthur Hayes brings up here all the while, again, it's just an opinion right now, we don't know exactly what they're going to do, is to see whether or not some of the other central banks of the world, such as the People's Bank of China, the Bank of Japan, ECB, the Bank of England, any of these major players out there outside of the Federal Reserve, if they're going to take the same course of monetary policy. And again, I don't have enough time to dive through every single bit of it here. I like the reference here to The Princess of the Yen by Professor Werner. That's a solid documentary if you guys haven't watched the documentary or read the book here in this case as well. Both of them are great sources to learn about how central banks can mismanage things and like to, let's just say, not put a crisis, not leave a crisis to go to waste. Anyways, the major point here is that he does provide some really interesting macro things, a lot of which, not to be rude, I bet will probably go over the heads of a lot of people. Some of it is still far out of my mind in this case. But the major thing, again, is that if you want to dive through it, you guys can continue to look through it. He does predict in this case an idea of a kind of rollover here. And the NASDAQ going into the spring here, where equities would fully roll over, have dead cat bounce, and get hit even harder. But all in all here, the major thing I want to bring to your attention here is really the claim that he has here at the end. Okay? And he does bring up some important points here, and then I'll dive into sharing my thoughts. So he's got the price predictions here, right? Not too far from where we are, around 40K right now, or 41K for Bitcoin. And he's calling for another $500 decline back to the general support range that we saw for Ethereum. And he mentions a couple of important points that I just want to read through here. There isn't much science to these numbers other than a gut feeling. The annoying part is that there are a number of altcoins he's already begun to accumulate because the prices are quite attractive. Even though some of these coins are already down 75% from their all-time high, I don't believe they can escape the coming crypto carnage. As such, I'm buying Crash June 2020 puts on both Bitcoin and Ethereum. Nothing is certain. I only ascribe probabilities to outcomes and trade accordingly. I fully believe that there is a chance my market prognosis might be wrong. That is fine. In that case, I only lose the option premium paid on my crash protection. I will be wrong if the correlation between Bitcoin and Ether against the NASDAQ starts dropping before a crash in risk asset markets. I'm pretty okay with that outcome, as I already am long in crypto positions. This analysis is purely an attempt to trade a short-term situation that I believe will transpire in risk markets and hedge purchases to attractively priced altcoins. He also mentions here as well that he feels in this case that he's kind of going against the grain here, that his more kind of not bearish narrative, I don't want to overstate it, but short-term bearish in this case, calling for us to come down to that lower price range and kind of having that fear against not only global central bank monetary policy, but the correlation with equities. He feels that he's kind of the outcast in this case, or at least kind of in the minority opinion overall for what's going to happen. Now, first off, I want to go ahead and state a couple things before I dive into my opinion. First off, I love Arthur Hayes' article here, I think it's actually a really fair take. It takes in the macro perspective, where so many bears have just said, look, there's this one model out of dozens that are starting to signal bearish tendencies, or I feel the price is going to go down. First off, Arthur Hayes admits that this is just an assumption here, but it's an assumption rooted with a lot of macro factors, major things that will drive asset markets and liquidity flows either inwards or outwards of markets like crypto. And I have to just say again, hats off to, again, I think probably one of the best theses so far for a bearish narrative here in the short term. And it's also one that's reasonable as well. It's calling for us to revisit down to that capitulation range around 30K, not going to 20K or 10K. I gotta promise you guys, there are buyers in this world, no matter how risk-off markets get, that at this point, after a year of consolidation sideways, we have seen that buyers will come in at that range. There is not enough sell-side pressure, and institutional buyers with so much cash they don't know what to do with it, even with quantitative tightening, will likely hold up those markets. Okay, just want to make that very clear at this point, right? Now, it's not to say it can't happen, but it's very, 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 very unlikely. Okay, and that's why, again, I've kind of talked about when we get to this 30K range, usually it's a safe bet, right? Now, to go back into this conversation, the things I like about Arthur Hayes is that in this article, he summarized some of the best things that can provide a bearish thesis for crypto. But the one thing I would like to remind you all of is that all the while, this is probably the best argument I've seen so far. The worst case scenario that he's promoting here is that by sometime in June, we would come down to 30K. Okay. I want you all to think about something here, because I know the first thing that a lot of people consider when they see these kind of price targets is they immediately go to the chart and they think, okay, well, I'm going to go ahead and I'm going to sell my Bitcoin here, and I'm going to wait for it to come down to 30K, and I'm going to, build up an additional 25, 30%, whatever whatever you really think the price is going to go to. You think you're going to stack up some extra sats or some extra Ethereum, or you're going to go short in this case from this range. But I want you all to understand here that that is not what Arthur Hayes is likely recommending, okay? Now, all the while, Arthur Hayes is not giving financial advice, nor am I here on YouTube. We're just sharing our thoughts in the market. What Arthur Hayes is doing with his actual positions, where he's putting his money where his mouth is, first off, he's already majorly exposed to crypto, and he's not getting rid of those positions. At least that's not what he's stating in the article. What he's stating that he's doing in the article is that he is buying various puts going into June of 2020 on both Bitcoin and Ethereum. It's important to understand the difference of what he's doing here versus what most people interpret from the article. Most people think he is saying, go all short, I'm selling all my crypto until we get to that price range. And it's not the case. He's buying puts in order to hedge himself in the short term. What he's basically doing is he's holding his existing positions, and with a fraction of his portfolio, he's buying puts. He's buying options that are saying that if the market price comes down to this range, he either gets the right to sell or buy, in this case, at a specific price range. Right? Basically, if the market goes down, he's going to be hedging himself at this point. He's basically in a de facto, not exactly, but probably close to a de facto neutral position, or one at least that is going to mitigate his losses if we do come down to that range. And if the market accelerates higher, he's also mitigating a potential loss in this case by just buying options contracts. Right? I know it can probably be a little bit overwhelming if you haven't traded options before, but the fact of the matter is that he's not all in short. And the market, I think, is reacting a little too harshly to Arthur's comments. And I think that's honestly, to be completely fair with you all, a big reason why this sell-off has continued here in the market. I think people are a bit overreactionary to the words of one Medium article. And that's not to blame Arthur Hayes. That's just, again, how the market will react. And I think, to be honest, if you guys want my take on it here, all the while, again, just like Arthur Hayes' article, it's just our takes. I think the important thing to understand is that going down to $30,000, all the while much more reasonable than what most people are projecting, I think coming down to this range is a hard bet at this point. We have had a global geopolitical conflict. We have had the fears of central bank monetary policy, people buying the words of the Fed rather than even its actions at this point. All the crazy things that could have gone wrong, right, in this case around the war and everything, happening during the first quarter of 2021. And we still couldn't get Bitcoin down to 30,000. There was buyers out there who wanted to buy into that period of fear where equities were down 20%. I just don't see in this case why crypto wouldn't accelerate higher in a system where there's just so much awash cash in the system. where interest rates are still incredibly low, all the while the Fed is promising they will rise over time, and I don't doubt that they will, but credit is still incredibly cheap. If you've got companies like MicroStrategy, buying up Bitcoin, and we wrote about this in the Dash report, who, will take out consistent, basically promissory notes or debt in this case in order to go out and raise more capital and buy more crypto. If interest rates for that capital from a private lender go from 1% to 2% or even 3%, do you think MicroStrategy cares? Do you think these institutions care? They don't. Because they're so solidly bet on Bitcoin because they know the annualized returns will outpace any interest payments they're going to have to make on that debt. On any cash that they have in their system, it is best to park it into something like crypto rather than leave it sitting in a bank account. And any short-term profit takers in the market, people who are deallocating for Bitcoin or who are selling it to go to Bitcoin Miami, there's always that rumor that causes a little bit of sell-side pressure. The fact of the matter is that as we've looked at this past year, buyers have come in at higher lows each and every time. And maybe that breaks. But I'm going to, again, stand by my word here and saying that I don't think that that's going to happen. I don't think it's likely. Right? And again, with all due respect to Arthur Hayes and the sense of the article he put out, I think he made a really good summary and case for it. And again, I think on the macro scale, I think the issue of central bank liquidity injection is going to be more of a challenge for equity markets. And I do believe we are going to see a break in correlation here from crypto markets and equities. Because eventually here, we're going to start to see as we break past the $1 trillion market cap, I think very much what Peter Thiel at Bitcoin Miami was talking about, where Bitcoin could really break away as a store of value hedge in the overall asset markets. And it's going to outpace equities in the sense of performance dramatically, seeing a stark discorrelation between these assets and really start to see crypto become a multi-trillion-dollar asset class. We've been calling again for some time as we go into the close of the year, into Q1, and possibly Q2 of 2023, that we would see a $10 trillion market cap. And so far right now, we're roughly around that $1.7 to $2 trillion market cap range for crypto. I think we are going to see that spring up event. We've seen these kind of gains before in the market. It just takes time, especially after this long consolidation channel. It's an opportune moment for it to happen in the market. Now, a couple of key things here again for ETH. If you guys want my prediction for ETH, I think the worst price range you're going to get here is around 2,900, 2,850. I think that's going to be coming down on this previous range of declining resistance and give us the board for price to spring up higher. I'm not selling my ETH. I'm not selling my Bitcoin. I'm holding out here in the market. Now, one important thing here that I thought was really interesting is that Arthur Hayes was talking about his increased position in altcoins. So again, this is something again that I want to emphasize here. He's not calling for a bear market. He's not calling for Bitcoin to go to 20K. He is confident that the market is going to spring up here in the coming months. And again, we've been diligent on this idea that it's still probably best to be exposed to altcoins here at these kind of prices. It's at a value range here for a lot of plays. A lot of them are much more fair valuations, par towards their revenue that they generate as a protocol, etc. All right, it generally is going to be at a decent premium. So one thing I wanted to bring to your guys' attention is today's sponsor, and that's Oneinch. Now you guys know probably about Oneinch if you've been making swaps in the cryptocurrency space. But one thing that I wanted to share here today that I think is a really phenomenal technology, and one in which is boosting the privacy and also functionality of swaps within the DeFi space, is their new peer-to-peer trading functionality. Now, as many of you might know, when it comes to doing swaps, whether it be through an aggregator like Oneinch or through a single AMM like Uniswap, the really cool thing about it is that usually you're just trading, in this case, against an LP pool, in this case, or a liquidity pool. You don't have to trade with anyone else. But there are some downsides to the convenience of an AMM. And the problem with it is that you can incur really dramatic slippage if you want to trade large volumes. But Oneinch's new peer-to-peer feature allows you, so long as you have a matching partner in the market, to be able to trade peer-to-peer at a fixed market rate between two separate assets. Simply put, if I have, for example, maybe 100 Ethereum, right, a large amount of Ethereum that I want to trade with some altcoin that would originally lead me to incurring a lot of slippage, I can actually connect with someone who has a large altcoin position in that specific coin, and we can agree to a specific market rate We can set an expiration time for this order, and it's all run through a trustless smart contract through the Oneinch ecosystem. So we can again specify the amount of crypto I want to sell and what I'm going to get from the other trader here. And this is really incredible stuff. Now this is a custom order here that I made myself. We can go back here again and we can see that we can manipulate all the different types of details. I set the taker address. This is the other person that I'm trading with. I can set it to expire here. So if I want to kind of set an ultimatum that it has to expire within a given time, so the market rate doesn't change too much in between. And I can also maybe, because maybe if I'm on the other end of the stick, buying an altcoin in this case, that might be really incurring high rates of slippage, I might try to negotiate in this case that I want to have a slightly higher premium or lower premium for that matter against the given market rate for trading. And that's where again you can start to modify the given rate here of wrapped ETH that I'm getting, or at least I'm paying in this case per DAI, right? So it's a really exciting system here, all the while maintaining a high degree of privacy within the transaction. Now, I just want to show you with you guys real quick how the actual process looks here. So first off here, what we're going to do is we're going to go ahead and click Create Order. Just go ahead and make sure to take a look at confirmation. It's going to go ahead and ask me to sign the transaction here. We'll scroll to the bottom here, and we'll go ahead and sign the transaction. And our peer-to-peer order has now been created. Now, the really cool thing that I want to share with you all about this is that this peer-to-peer order, the way that it actually gets shared, and this is really cool, it maintains a really high degree of privacy, is that I've not only made it specific on who the taker address is, in this case, as the other trader would provide the address, but I actually share that trade opportunity by simply just copying this link here to the actual trade. So I can basically take the trade, copy it, and then the other trader here would just simply open it up in their browser. So we're just going to go ahead and hit enter here. And of course, on this other end, the user would have to connect the wallet, but they would be able to see that trade opportunity from their device. And I think this is really cool. I haven't seen anyone really do this within the DeFi space. And I think that this is going to be a really interesting tool for people who want to basically do the equivalent of like over-the-counter transactions in a peer-to-peer fashion, avoiding the mass amounts of slippage in the market. So if you guys are interested, check out the Oneinch ecosystem. And I want to really drive in this point here again, that Oneinch is not only just a AMM aggregator, right? That is its bread and butter. It's its key focus. But it also has various earn programs. It has this new peer-to-peer trading feature. It's aiming to become an all-in-one ecosystem to get you the best possible deals and functionality for DeFi as a whole. So you can get access to the kind of altcoins and opportunities you'd really want to get exposed to in the crypto space. Now, let's go ahead and dive into one last piece of information here, guys, that I want to summarize here when it comes to analyzing the market. And this is the Bitcoin price prediction tool here, or price forecasting tools. This is something that you can access for free on lookintobitcoin.com. And it summarizes a whole range of different types of market indicators here, both for bottoms and tops, such as the delta top, top cap, terminal price, the balance price, and CVDD. Now you can read into the description of these indicators, and you might have to dive a bit deeper than just the core descriptions it gives you. But I want to go ahead and really bring in this point here about where we stand right now in the market. We are right in the middle here of the next super cycle, or the next breakout in price. Maybe super cycle is not the right term, but I don't think we're at some point here where we're expecting a bear market from any of the major models in the market. It would go completely contrary to what the vast majority of analytics tell us. Now, it might be the sentiment of most traders and investors, and that's actually taking it back to Arthur Hayes' article. I would say the vast majority of people are either in a, let's hope that things are going to go up state, or they're bearish now. They're not confident. They're not bullish. The sentiment right now, looking at the fear and greed index, is signaling that a lot of people are just kind of concerned, right? But we tend to find that when most people share that mentality, that's when market prices start to trend higher. When people are most doubtful, that is when institutions, large investors, and whales stack up positions. And they lead towards the kind of supply contraction that drives up the initial wave of prices. And therefore, when retail investors or those who are just purely short-term holders and speculators, that's when they come into the market. That's when they start using absurd amounts of leverage. That's what drives these insane mid-cycle rallies, and therefore later on mid-cycle corrections. Looking at this chart here, guys, I feel really, really confident that we're yet again going through another long drawn-out consolidation period, just like we did back here from July of 2019 here towards October of 2020. And we have talked about that many, many times here on the channel. When we start to zoom out here when it comes to market price, bring it here to the weekly, right? We can see here that we're just setting up like we did back here for the next spring up here. And we've kept these drawings on our chart for a long period of time, and we're going to continue to do so. We don't care about the short-term noise, the short-term volatility. We're betting on the spring up here, going in to the spring or summer, getting back above and being able to see Bitcoin not only claim new all-time highs, but claim into 6-digit territory. So, anyways, I've rambled on enough, guys. Thank you all so much for listening today. If you like this video, whether you agree or disagree, consider dropping a like, consider subscribing and hitting that bell icon. If you like these kind of macro reports on the market, you can always sign up for the Dash report down below in the description. It's a great way to support the channel. But that being said, everyone, thank you all so much for watching, and I'll see you all in the next video. Take care, everyone.